Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 24th of October. I'm Daniel Lam, your host for the podcast. I had a unique experience at a media engagement last week when I did an interview for an Arabic language channel for the first time. The anchor's question was translated into English real time, and so were my answers from English to Arabic. The question that stood out amongst others was whether the 60/40 equities bonds portfolio would be facing more challenging times ahead. Now, long-term followers of our CIO team's output would recall that over the last 150 years, there were only 4 years when both US stocks and bonds were down for the year. And starting from August this year, 2023 may yet to be heading towards that direction, with US 10-year yield going from below 4% to the 5% area, and the S&P 500 coming off from close to 4,600 to dropping below 4,300. The conflict in the Middle East seems to have exacerbated the negative correlation between bond yields and US equities. Now, are there worse times ahead for the 60/40 portfolio? Do we see continued slide in both stocks and bonds? Well, on the bonds front, liquidity conditions remain extremely tight. Therefore, leads to yields being at elevated levels. So for example, we see strong dollar for safe haven demand, gold is challenging triple top, and oil continues to show strength. Now for equities, things may appear to be reasonably okay. So for example, the short-term volatility index of S&P 500, i.e. the VIX index, has just broken above 20, but it is still below the March highs at 30 when US banks came under pressure. However, we would argue that the sector dispersion is keeping index volatility low, but the sector correlation may increase if the US 10-year yield rises decisively above 5%. It seems that the options market may not be pricing in the fact that the tails have gotten fatter, i.e. the probability for extreme outcomes has increased. Now, our SCB Global Research colleagues pointed out that investors should be watching the shape of the VIX volatility curve. Now, if the curve were to invert, i.e. the short-term VIX level exceeding long-term ones, then it may indicate demand for short-dated options surging relative to long-dated ones, and this may be a strong sign of distress in equities. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.